Hello everybody, welcome to my channel. Glad to see you back. My name is Toof, and I welcome you here today to analyze a new study case. Every time it's a different company, different aspects, different analysis, different approach, and I'm glad actually to present you very various companies so that actually we can learn together and have a better, let's say, get better a day after day. Today, the company I want to present you is Charles & Colvard, ticker CTHR, and then basically they are specialized into lab-grown diamonds and lab-grown moissanites. This is actually a very small market cap company, as of only $41 million. So you call that a penny stock, you call that a micro cap, whatever you like. And they are specialized. They have basically two different types of very specific products. The first one is a moissanite that actually they originated a patent in the past that was valid until 2015, but they are the initiator of the development of this lab-grown moissanite, which is actually even brighter than diamond. And on the other part, they recently developed that in fiscal 2021 is the lab-grown diamond that they call Cadia. And this one is actually growing much faster at 140% year over year, but it still represents, I guess, a low part of the revenue. Otherwise, you would have seen like crazy revenue increase. What about the chart? But look at this. Over the last 2 years, it went up and down, but obviously the bear market of January 2022 until now just hit the stock so much, and it went from $3 to 1.35. So it's a 50+% loss. For information, I'm invested into this company, but I like a small percentage of my total portfolio, and I invested around $2 plus dollars because a lot of insiders were buying, so I was pretty interested into this at this stage into the valuation, but obviously it went even more down, and other insiders kept on buying at this stage of 1.35. Now there's a question, when you own something that just goes down, what are you supposed to do? And this is where the analysis of the stock company allows you to take a good decision, a wise decision. And then for me, I will keep it until it goes higher. As an information, I'm not a financial advisor, so please do your due diligence before you do any investment. Okay? So let's go now into the metrics, because for me it's important to share that with you. And that's for me the most important slide I will present you during this session. As I was mentioning, so let's go to the various metrics here. The market cap is $41 million. And I want to share first the enterprise value. And for this, you will need at least to know how much cash and equivalent and how much debt they have. Today, they have no debt. Good company, a lot of cash, $17 million compared to 41 is amazing. It's actually 30+% of cash for that market cap. So the enterprise value is actually much smaller, which is around $22 million. As you can see, over the last 4 quarters, they were profitable. And you can see that the net income in total was around $4 million. That gives us a 4 million divided by 22 million EV value, a kind of PE ratio of 20%, of 5, so a PE of 5 and a yield of 20%. This is to me an amazing opportunity right now today. Price to book, obviously, if you look at all their inventory, $25 million plus 13, because the inventory has been split into total inventory, short-term inventory, and long-term inventory of $25 million, plus their cash. It means that they are trading below the book value. And you will understand after that why it's important and why they decided to initiate a possible buyback anytime soon. Regarding the operating revenue per employee, very good, $400,000. It's actually quite a little bit higher than the average. They have a steady gross margin around 50%, so 45 to 55, which is to me indicating that they have a decent, let's say, moat at the moment. The operating leverage still needs to be confirmed. Still needs to be confirmed over the next quarter to see really if there's a good tendency, but I can see that So for the years 28, 19, 20, 21, and then here's TTM trailing 12 months. There's a tendency of improving, but obviously now these days they are spending a lot of money to get known because it's a small company. So spending more money on the ads. So let's see how it's gonna turn. What else can we see here? Over the last 3 years or 2 years, they raised them, maybe they diluted a little bit by 9%. Nothing really alarming here, especially knowing that they have enough cash, so you don't expect to dilute anything. So a lot of green lights here. Here, that's just a quick detail on the inventory and how they split it to the inventory or to the long-term assets. This is an extract from the SEC.gov, and then after you can go on, put the ticker CTHR, and then after you will have all the details. Okay, I just put that here in view so that you have an idea of where to find the information and where I find the information. Now look at the marketing. That's actually maybe one of the most important point is today there's a company which is profitable. They are very young. It's a young company, so they need to get known. And for this, they have to make advertising. And for that, I'd like to know basically what is the strategy of the company, of the management. And for that, you just go in the investor presentation and dig a little bit. And that's what I did for you here. Looking at the strategy, they call that the omnichannel strategy. So basically, they invest through various means of, let's say, reaching the client, which could be social e-commerce, which could be distributors, retail stores, marketplace. But actually, the most important is possibly their own website, which actually will enhance the direct to consumer. Why is this so important? Is because all these ones, you need to place some ads, and these companies will take a percentage of the revenue. Whereas when you sell on a direct website, they will have less advertising to do, and also they will have a better margin. On top of that, as you can see, it looks like very organized. They have a clear view or clear vision on what they are supposed to be doing with the OPEX. Is also they have to develop their advertising content. And they realize something that actually is very good to me, is that they will they're planning to enhance their video content. And for that, they invested into what they call a state-of-the-art production studio, which is 8,000 square foot, and also a signature showroom, which will actually help to improve the video content and then to distribute it on Instagram, on TikTok, because these days the marketing is not through pictures, but more through videos. So I'm very glad to see that they have a strategy, omnichannel strategy, and also that they are investing into creating their own content. That's super important. Combination of both could grow, could actually help grow the revenue very quickly. Another point is that, as I was mentioning when I was showing you the chart, is that these insiders, the management is buying even at a high price. So for example, at $3, they were buying like $127,000, up down to $1.9. And also recently on May 27, so just a few days ago, another director, Neil Goldman, just bought for $100,000 at $1.31. I think it's a great investment. Also, another point that is amazing is that they recently mentioned, like just a few days ago, so that they will announce a buyback program. So meaning that they will not dilute, but actually they will reduce the number of shares available on the market. And the main reason why they announced this is because the current share price is trading below the book value. The book value is supposed to be $1.96 or something like this, compared to $1.3, which is the current share price. $5 million also, just realized that it's approximately 12% of the market cap today. So the buyback is a massive weapon to avoid a a reduction in share price, a drop in share price. So as an investor, you're always thinking about risk and reward. And here to me, the risk considering this buyback program is highly reduced. Why? Because if the share price goes lower, they will initiate the buyback. Super important. So now as a conclusion, I will point all the different points and then you will see that there's more pros than cons here. So first, it's a profitable company, as I was showing on the DNA card. They also have a great balance sheet, plenty of cash and no debt. They also have access to a $5 million credit facility from JP Morgan. So I guess that they don't need it for the moment, but in case they want to, for example, do some inorganic growth by acquisition, it might be possible to use this credit facility. So it's great. Another catalyst is that summer is coming after so many COVID years. So obviously lots of rings will be purchased in the coming quarter. So it will boost probably the revenue. Great for the for potential share price increase over the next months. Even though I'm a long-term investor, I'm not against a little catalyst to boost the current share price. Great marketing strategy I was mentioning. They are promoting the made and not mine culture. So it's going to take time. That's why they're investing money into this philosophy, into this brand name. Obviously, it's not Tiffany, but Charles & Colvard is growing slowly. Also, as I was mentioning, they have their showroom studio that will be finished by next quarter. So next quarter is, this summer. So it will be perfectly in time with the potential weddings. So I hope that they can put it early enough in online so that they can promote the video content right now. Lots of recent buying from the insiders, which is very good point. And also their $5 million buyback program, which actually is 12% of the current share price at $1.4. This will help the share price to avoid to go lower. And to me, that's the reason why I'm investing today a little bit more, because I know it's great. It's a great price today, and also because it's trading below book value. The current price to book is 0.6. And last point, because actually there's not enough, is that they are developing their revenue on their website. charlesandcolvard.com is actually growing, and as I was mentioning, it's super important because they will have to spend less and less money on the advertising, which will increase their operating leverage. What about the cons? So obviously it's a new market. You don't know what's going to be the tendency if people want to go back to the real diamond because maybe it has a better value. I don't know. Obviously, I forgot another pro is that because of the Russian war, there's been like some price increase in terms of diamond because of the supply reduction. So obviously, it made now more sense to buy a lab-grown diamond that might be a little bit cheaper. And actually, it's like a big pro in terms of market shifting to the lab-grown diamond. So let's go back to the cons. The new market, obviously, you don't know if there's going to be a consumer shift. You never know. So that's something we need to follow up. The patent also for the moissanite expired in 2015, so any competitor can start diving in. And if the big companies start like Tiffany start investing into this, there might be some headwind for this small company like Charles & Colvard. And also, as I was mentioning on the DNA card, this company still needs to prove their potential operating leverage. So by basically increasing their revenue and not spending so much on the advertising. They are very profitable now, so I don't guess that there will be a complete shift back into a loss of operating leverage, but it's still something we need to look at over the next quarter. So compared to the other three companies that are presented like SMSI, CPRX, and Katana, today I don't provide an operating model. Why? Because the company didn't give enough guidance so that I can start building the operating guidance. the operating model. However, considering that there's a very nice, let's say, floor price today at 1.4, and considering that there's a potential revenue increase and improvement of the OPEX, I still think that this company could double over the next year. That's why I stay invested, and I will not sell my shares at any time at this price, even though I'm losing maybe 30% at the moment compared to my purchase price. So as you can see, maybe we will make another video in the next 2 quarters to give a feedback, to give an update. But I'm very interested into this company because it's only a $40 million market cap, and the market of gems is like total addressable market is like $40+ billion. So even if they capture maybe just 1% of the total market, it's a very high potential for maybe a few X share price increase. So I think that's it. I hope you enjoyed. Sorry if it's like a bit fast presentation, but today I want to make it a brief presentation. If you have any question, just drop a message below. Maybe give a like if you stayed until the end of the video. I hope you learned also something with me. The intent of this video is just to promote video content, but not just for likes or monetization. It's just for sharing, just for learning together and then improving our investing skills. I wish you a great day, and then I see you soon for another video, and I hope you enjoyed as much as we did. Have a good day. Bye bye.